Welcome, everyone. I'm Certified Kingdom Advisor Mark Trice here with Jesse Hamilton. This is
Everybody.
Clear Vista Financial Perspectives. It's our monthly market update and kind of information on what's going on in the economy, the markets, and everything else. It's been an interesting month. July's been a good month for the markets and so forth. We're starting to see a little headwinds here since we've kind of reached resistance in the markets for the short term. But we'll get into that a little bit. Jesse, let's just go ahead and jump in. I'm going to turn off our camera for those that are watching online so you can see all the slides and things. Go ahead.
So today, here's our agenda. We're going to talk about the July 2023 performance for our four major indexes that we usually cover. And then, of course, we'll do our market commentary and our economic update. And the big question we want to discuss today, Mark, is are we headed for a recession? We're getting a lot of mixed signals here. I do want to encourage you to interact with us if possible. 254-282-0495 is our text number right there on the screen. You can text us questions. We would love to hear from you, or of course, info@clearvistafinancial.com.
Yeah, send us your questions, and text is usually the easiest at 254-282-0495. We'll answer them live on the program today, or we can respond to them within 24 hours. So thanks for joining us today. Jesse, let's go on and get an idea of what happened in the markets last month.
Great. So we'll start off, as always, with the S&P 500, the large cap companies in the U.S. It actually fell in the first few trading days of July, but then it rose to a high on the 27th. You can see the candle chart here to the right. So this index is coming up to resistance around 46.37. But Mark, actually in the last couple of days since the screenshot, we've seen it turn back around to the south a little bit.
Yeah, that's just for some retracement, and we'll talk about that in just a moment. And that's a normal thing when you get to the top near resistance and things.
Right.
We are still not anywhere near back to where we were in the high of January 2022. But we are making some progress now.
Yeah, and we're also coming up on that resistance, which is from March of 2022. But
right.
Overall, positive trend in the index. We'll see what happens during this month. So next is the NASDAQ, which is the tech-heavy companies. This includes what is being nicknamed this year the Magnificent Seven, the largest companies in the country.
You seen that movie, Jesse?
No.
Oh, you need to watch that. Yul Brynner.
Well, the NASDAQ,
the old version, not the new version. The new version is not any good, but the old version with Yul Brynner, and I forgot the other actors in there, but it's a really good Western.
I'll have to check it out. Anyways, the NASDAQ went through a rebalancing at the end of July, which was the first time out of schedule since 2011. It's kind of an interesting rebalancing that took place because these seven large companies grew so quickly, but we expected some volatility this month. The index was plus 4.05, which is great for the close. It peaked on July 19th, and it did break through that resistance at 14,000, but it's now become a line of support. And of course, just like the S&P, since this screenshot was taken at the close of the month, we're actually down from here.
Yeah. So good news, we're seeing the trend moving up with the NASDAQ, and the NASDAQ's been kind of the driver of the broad indexes for the entire year so far. But, you know, we're seeing those things, and how much more can these seven companies go higher? It remains to be seen. Like I said, we're facing a few different things now than we did earlier in the year, and we'll get into that later in the program.
Next up is the Russell the Russell 2000 Small Cap Index. This index showed strength in July, despite starting off with a quick drop off in the first 2 days. And then we started seeing the small cap rebound in June, and it is encouraging to see. So improving small cap indexes could potentially mean more breadth in the market moving forward, but we don't know that for sure yet. This index does tend to be volatile, so we'll be watching it closely in the coming weeks. But you'll see 6.11% during the month.
Yeah,
that's
pretty good.
Strong.
And that outperformed the S&P 500, which you know, we've talked on previous programs that we're looking for that convergence, and for the S&P and the Russell 2000 index to converge together. They've been spreading apart for the first few months of the last few months. We don't like to see that. We like to see them converging, knowing that there's broad breadth in the rally in the market. We're starting to beginning to see that. But of course, this index also rolled over at the first couple of days of August as well.
Right. So our last index for today, the long-term Treasury index, and it could not make up its mind in June, if you remember that. But
Is the Fed going to pause? Are they going
Right.
to cut rates? What's going to happen? That's a lot to do with that.
So of course, we'll talk about the Fed's decision in just a moment, but this index did make up its mind for the downside, minus 2.81%, fell to a low on July 27th. And this is a volatile pattern for an asset class that is often looked at as fairly stable part of the portfolio.
Yeah, and we've seen that deteriorate even further, especially in the light of the U.S. government bond or debt rating being lowered again. This happened back in 2011. We're going to cover that in a little more depth later on. But if you are holding long-term treasuries in your portfolio, please give us a call, because that is something that is costing you a lot of money right now.
Right. So this is our next chart, which is the large caps overlaid with the small caps, right? The S&P and the Russell 2000 on top of each other. And you can see there in March, we started to see them separate. They should be tracking fairly together. And of course, now I would call them correlated, but they're not on top of each other anymore.
Right. And we like to see that as an indication of market breadth. The good news is that they're both trending in the same direction in the month of July. We want to see that continue to improve, and hopefully maybe those come together a little bit, because usually when you see a broad-based rally, you're seeing growth in the small cap market as well. And so we want to see that continued improvement, and hopefully small caps will outperform in the future, but it's still too early to determine that right now.
Yes. So we covered this last month, but here's the updated version of the price channels for the S&P 500. And you can see that it just briefly rose above the upper channel line in July, but of course it's failed to stay up there in the last few trading days. And as of right now, as we're speaking, Mark, the S&P is actually below 4,500, which is another support line.
Yeah, and what we're looking at here, and I was going to add a chart on this, and I failed to do it, but in time for the program. But if you see my little laser going across here, it's kind of the mean average, if you will, of that. And when you're dealing with different types of mean reversions and things, here I can do this here for the line. It should disappear as soon as I do it. But when the markets have a tendency to revert to the mean, and we broke outside this price channel in July, which is a good thing, but most stocks have the tendency to revert to their mean, and our mean is really the blue line here on the chart. And you want to make sure that we're watching to make sure it stays above that mean, but in the last 2 or 3 days we're seeing that revert to the mean. How much will the S&P sell off from here? We don't know, but it's something that we're watching rather closely.
So here's I think our last chart of this section.
Hold on here, I'm not advancing there, Jesse. One thing to note here is that the number of stocks that are above their 200-day moving average, when we talked about this in previous ones, it's in this little middle chart here with the red arrow. We're seeing last month when we talked, the number of stocks that are above their 200-day moving average were in the 40s. And now we've seen that increase to 74. 74% of all the stocks that are there. I think that's gone down a little bit lower today, but that was encouraging that we're seeing that trend continue and seeing more breadth in the market.
Right.
So good signs.
Yeah.
Still a lot of uncertainty going on with the markets, but still some good signs that we're seeing here. Okay, next up, we'll do a little bit of economic update, but I want to make sure that people know that you can text your questions to 254-282-0495. That's 254-282-0495, or just send us an email at info@ClearVista Financial. We have folks representatives monitoring that for us, and if you send that in during the program, we'll be glad to respond to that on the program.
So Mark, these headlines can really give investors a sense of fear, but so what's really happening? What happened with the Fed?
Well, the Fed, as we expected, the Federal Reserve continued raising interest rates with a 0.25 percentage point increase. And that brings interest rates to a 22-year high.
Wow. Okay.
So we haven't seen this in a while. And, the Fed chairman, Jerome Powell, said it was too soon to tell whether or not the hike would conclude a series of increases aimed at cooling the economy and thus hopefully bringing down inflation. But the central bank would decide whether to keep lifting rates based on how the economy fared in the months ahead. So they're looking at, in particular, with a focus on making progress in inflation.
So yet another vague response from Mr.
Yeah,
Powell.
a little bit vague, but we look at that. We try to read through the tea leaves there. We kind of watch the press conferences and so forth. And there's really only two reporters that know what they're doing in that reporter pool, and we pay attention to what they're asking and how Chairman Fed actually responds to that. So it was a unanimous decision. The Federal Reserve, all the different regional presidents voted to keep that Fed funds rate between a range of 5.25 and 5.5%. And that followed that brief pause in the last meeting that they had earlier in the spring. This is the 11th rate rise increase since March 2022. When they lifted rates at the time, folks may remember, it was near zero.
Yeah, it was.
And markets were mixed after this decision. We were expecting that. And that, everything finished flat about that time. I think since then, we've saw the move a little higher. The 10-year Treasury yield fell to 3.85. I can tell you today that 10-year Treasury yield is above 4%.
Yeah, it is.
So interest rates have been rising. A lot of it has to do with the bond rating change with that. So here's kind of our observations from this.
Yeah, so these are just some comments that we had, that the Fed is having some success in bringing down inflation as far as raw materials and factory gate prices, but they're really failing to bring down consumer prices in any meaningful way, right? Because the CPI is still stuck near 5%.
Yeah, I mean, if you're going to the grocery store, folks, you're seeing your price of your groceries keep going up.
Yeah,
and that's part of the core inflation that the Fed is looking at. The news is going to report overall inflation with being around 3% year over year gain.
Yeah.
Well, the core inflation was up near 5%, right? So 4.8, 4.9%. And we're seeing energy prices rise again. So do not be surprised that when we see the July inflation numbers come out here, it's the 10th or the 11th of the month,
right,
that you have year over year inflation rise again.
Yeah.
Okay. So we may see this
go up.
We may see this tick up a little bit. But we're seeing more spending. The things that we're observing, the Fed's really watching, concerned about is employment.
Yeah.
Our employment vacancies are dropping, but then employment numbers are going up quite rapidly. Wages are rising. That's important too. That those all would be good signs of a healthy economy, but to the Fed, it means the economy is still overheated.
Right.
So, and this is, numerous corporations are still tended to raise prices,
yeah,
right?
They've
That's
signaled
one thing
that. And of course, going back 2 months, the whole debt ceiling deal removes all spending caps for the government.
Yeah, and
that's
that
another
was,
thing.
Yeah, it wasn't. They didn't raise the cap. They just said, "Hey, game on.
Yeah.
Have fun, spend some money." As the government continues to spend more money, that's going to create more inflation. So, write your congressman if you haven't done so already. Ask him why in the heck he voted to raise or to eliminate the debt ceiling cap until the election's over, so everybody can support their favorite pet project, right?
Right.
Okay, jumping along to the yield curve. Now, this is the end of the month. This is a graph that's showing on the left-hand side the short-term Treasury T-bills, as we call them, all the way to the right side showing the yield on a 30-year Treasury note. We're still seeing this inverted yield curve, and so which really started to invert last year in March. We're well beyond a full calendar year of this inverted yield curve. So, Jesse, just as a reminder, our listeners need to realize that when we've had an inverted yield curve like this, because a normal yield curve looks almost exactly the opposite. I'll draw it on here so that we can spotlight this. But a normal yield curve looks something like this. It's the exact opposite. And so right now we're seeing that yield curve inverted. And we're concerned about that. That typically has been a precursor to a recession. Now, I feel like this time's a little bit different. The data's all mixed. It's very inconclusive as to where we're going. And a lot of analysts have really has said that, a number of the economic analysts have said, some of them have dropped the recession prediction. Some of them said it's still here, maybe just further out. We don't know. But this is a pretty strong indicator historically of a coming recession.
Yeah, and the 10-year rate is the one that really affects borrowing costs for American consumers, right? And
That's right.
That's hovering just around 4%.
4%. Well, we know it's above 4% now.
Yeah.
We talked about that earlier. But the 4-month yield's around 5.56. The 30-year yield still hovering around 4%. It's been going up, but it's still the inverse of the other stuff there. So that's something we're watching really closely, because this affects a number of different things in our economy going forward. So now this is, let's compare this chart here to the previous one, which was from the end of 2022.
Yeah.
So it looks fairly similar, but you see the short-term T-bills were much lower at that time. Now they're much higher, and that's basically because the Fed's been raising interest rates so quickly.
More like a 1.5% higher for a very short term.
And here's one of the things that we are concerned about: personal income. When personal income rises, you have more money to spend.
Right.
And that causes prices to inflate as well. So now it was below the consensus expectation of 0.5%. Okay. Personal consumption rose 0.5% in the last in June. That's up about 5.3%. Personal income is in the past year. That's good, but inflation's been higher.
Right.
When we talk about disposable personal income, that's income after taxes, that increased 0.3% in June as well. And it is up over 7.9% from a year ago.
It's quite a lot.
Jesse, why don't you talk about the overall consumer price deflator?
Yeah, so it rose 0.2% in June, but it's up 3% versus a year ago. And the core, of course, excludes food and energy, and it rose 0.2 in June and is up 4.1 in the past year. So after adjusting for inflation, the real consumption rose 0.4% in June and is up 2.4% from a year ago.
So now consumer spending outpaced incomes in June.
Yeah.
And that's a pickup in spending across all major categories. Now, inflation continues to take a toll on the economy, which is also, hey, we're feeling the effects of that decline in the money supply over the last year. We're going to talk about that in just a second. The Fed's fight is not over, and there's plenty of room to stumble before we get across that proverbial finish line.
Right.
So let's go on here and look at this here. This is that change in that PCE prices from a year earlier.
This is, of course, the measure that the Fed uses to determine a lot of their rates.
Right. And so they're looking more at the core. While it's been trending down over the last several months, it's still much higher than the 2% target that they like to look at.
Yes.
So we were looking at an article in the Wall Street Journal the other day talking about this. And, in some ways, this reinforced some optimism that the inflation can fall without the U.S. suffering in a recession. But then there are others on the other side that say that, no, there's still a high risk of recession.
Right.
The economic output accelerated in recent months on the back of solid consumer spending. We've seen that in some different places. Inflation cooled a little bit, but wage growth is still elevated. So it's like the Fed has one half of the equation that they want to see to bring inflation down, but not the other.
Right.
And so there's still some time and things that need to happen here.
Yeah, this is an interesting chart that Bloomberg released that just shows the trend in Google searches for the word inflation. So obviously the public was very interested towards the end of 2022. It's dropped a little bit, but the real question is, have the U.S. consumers gotten used to these high prices?
Yeah, we become complacent, and so we're not going to be concerned about inflation anymore. I think we are. My grocery bill keeps going up.
Yeah, it does.
And so I think inflation is still a problem here, but it seems to be less of a concern for some people. And I think that's in part because, wages have risen as well, but that is a domino effect, Jesse. It's like, if I have more money, I'll spend more money.
Right.
And we're seeing savings dwindle and so forth. So let's jump to the question we've been asking here. Are we headed for a recession? Now, in the press conference last week, Federal Reserve Chairman Jerome Powell says that the Fed staff is no longer forecasting a recession. Well, that should be real positive news, except for there's a lot of data that's pointing to the likewise opinion here.
I feel like the Fed has too much power to just say, "Oh, we're not thinking that's going to happen anymore."
Well, that's why the market moves based on a single word sometimes,
right,
when in his press conferences. So, this is a positive sign, but it doesn't mean that interest rate hikes are over. And so remember back to March, right? After the failure of a number of U.S. regional banks, the Fed's staff, which are quite influential,
right,
their economists, began forecasting that the economy would enter into a recession later in 2023. As of the last meeting in June, the staff had maintained that forecast. So
it's
now in
recent.
one month, they've decided there's no risk of recession or no, but I tend to disagree. That doesn't mean we'll have a bad one or anything, but it's still something that we're continuing to watch here. So now this would just happen just the other day. We don't have, that's why some of our data on the market trends and so forth are not reflecting this, because we focus on a month over month type situation. But on Wednesday, Fitch Ratings, which is a bond rating organization that looks at U.S. government debt, corporate debt, and so forth, they downgraded the U.S. government's credit rating. And this is weeks after, President Biden and Congress came to the brink of an historic default.
Yeah, we mentioned that earlier.
But Fitch warning about the growing debt burden and a political dysfunction in Washington. What are they talking about? This? I mean, yeah, of course there's political dysfunction in Washington, but I think this is more a political statement than anything. It is going to cause some volatility. If we go back to 2011, Jesse, do we have a chart on that?
Well, I had it in, but I decided to take it out.
So we go back to 2011. There was a lot of volatility in the markets in the coming weeks after the government got their credit rating lowered down. It was back in 2011. We had a AAA grade rating, and
now it's AA plus, right?
AA plus, I believe, is what it is now. So this is Fitch. I can't remember if it was Moody's or which rating agency.
I think it was S&P.
Okay, Standard and Poor's. So we're looking at that. It's kind of what this is saying is that, hey, there's a higher risk now for buyers of government bonds that, hey, the government may not pay you back.
Right.
And when you see these ratings drop, because we had AAA plus,
which is the top rating.
Which is the top rating. In 2011, we got downgraded to AAA. Now we're AA plus. And you can see there's a progression. You get down into the Bs, then that's very high risk. And we're wondering, who is going to buy the Fed's debt?
Yeah.
And what's been happening right now is the Federal Reserve has been buying, the last couple of years, have been buying the government's debt.
Mm-hmm.
And so it's almost like, Jesse, it's like you're moving from money from the right pocket to the left pocket. All right. It's all staying, it's still a pair of pants, and they're your pants, but you're moving from one side of the ledger to the other. And how long will this go on? I mean, that's what the Federal Reserve did, was buy bonds from the government because no one else wanted to buy them during the pandemic when we were printing so much money. And by the way, we don't have a debt ceiling. So guess what? We can print as much money as we want. The government can. And we're seeing that now. What's happening is that the Federal Reserve has been trying to taper and reduce their balance sheet. So moving from the left pocket to the right pocket. But now the Fed's got lots of room here to sell money and sell bonds. And also they're going to have to pay more yield on those bonds because not many people want to buy them because of the risk involved.
So does this damage the United States reputation as, that guaranteed risk-free return type place?
Yes, absolutely. It has. Now, how much remains to be seen yet, right? But it's a benchmark, right? The Treasury serves as a critical benchmark for returns on stocks and bonds. We'll continue to see that volatility, I think. Back in 2011, there was quite a significant drawdown. Yeah. But long term, it didn't have a great effect. I think there was a 19% or so drawdown in the fall after the debt rating for the government got downgraded then, but it continued on up afterwards. I remember that quite well. Mm-hmm. I think we'll see similar volatility here in the coming months.
So here's the other half of the coin. Mark, the Fed thinks that we're not headed for a recession, but some of our other economists that we follow do, right?
Yeah. So, we look at a number of different economists, and sometime if we meet in the office, we can talk about economist jokes and things like that. But no one ever goes back and examines whether or not that economist was correct or wrong in his predictions, because people don't care that much. But we think that, during a recession, when we think it's coming, because we artificially stimulated the economy during COVID.
Yeah.
And the money supply just spiked big time. And that money's being spent down. And so there's some that say, because there's so much cash, in the system, we're going to run out of that money in the system, and people are going to stop spending as much, and that's going to cause the economy to slow, and so forth.
So what about home prices and mortgage rates? That's affecting this bender.
Well, and so mortgage rates, along with credit card and auto loans, are so high now that those taking out credit at current rates will be squeezed enough to cause spending to fall.
Yeah.
Now, so we've done this before on the Spend Life Well show as a podcast. We were talking about rates increasing and how much that impacts a home buyer who's looking to get a mortgage. So in 2021, looking at the median price home in the country,
20% down deal type of
20% down and financing the rest, a homeowner would pay about $1,180 a month. And now that situation, they would pay roughly about $2,086 a month. That's a 77% increase, Jesse.
Yeah, that's a lot.
And that's a lot of extra mortgage payments, about $10,000 a year, almost $11,000. That's a lot of money for a typical household to burden. And so some analysts and investors are still concerned about that. I would be too. The higher cost of borrowing could slow the bout of home buying. Now we're not seeing that necessarily right now, but that will have a long-term effect. I think a lot of it is for the millennial generation, Generation Z that are coming out, maybe wanting to buy a home. They're looking at, at 5, 6, 7%, 7.25 is what I saw the other day, 7.25% mortgage rates. And they're thinking, this is crazy. That's outrageous.
Yeah.
And for those in Generation X and the baby boomers, 7.25%, it's like, yeah, we've seen that before, right? In the 80s and even higher in the 80s. Sometimes mortgages were up 15, 16% for a typical buyer. So there's a lot there that's going on that we look at. Here's the money supply chart. This is not as dramatic as it really looks, but what you can see here, if I can get my little marker here to annotate just a little bit. You saw in January 2020, after COVID hit, we spent trillions of dollars. What was it, $11 trillion that was pumped into the economy? We didn't
spend it, we got it.
We got it. It was pumped into the economy. And typically when you start to see that level contract, that's a sign that people are spending a little less, or there's less money in the system. And, M2 measures things like cash, checking deposits, other deposit accounts, CDs, et cetera. And you just see that artificial stimulus there that really is beginning to draw down a little bit. Look at here, and we're going down. We saw in May, it ticked up just a little bit, but we're seeing that trend down again. And so when the money supply contracts, we feel like that is another sign that we could be going into some type of mild recession. But let's talk about some of those signals.
Yeah, a couple more signals. And of course, we know these things are coming up. Still, a lot of analysts argue that the upcoming student loan payments, gas prices, and food prices will undermine consumer spending. So we talk about the core, which take those things out. But we got to buy gas we have to buy gas to come to work. We have to eat.
And we're going to have to be paying back those student loan payments.
Exactly.
How long of a break did the people have that have student loans?
Almost 4 years.
4 years almost. And so now, guess what? If I'm not having to make those student loan payments and I'm thinking that President Biden's going to eliminate my debt for me, so I don't need to worry about that, do you save that extra money? No, people spend it. And so now we're not going to be able to spend that. So we're seeing that extra cash savings dwindle, whether they were coming from stimulus checks or just good savings habits.
Right. I just think it's so interesting that everyone talks about core inflation, but we still have to put gas in our cars every day or every
Right.
week.
Energy is a big component. And if you've been to the gas pump lately, you know that gas prices are higher than they were a year ago. Again,
Right.
getting close to that $4 mark again.
Right.
Okay, so what does this all mean for your financial plan?
So as always, we encourage you to take action on your financial journey, and we're at just one point in that financial journey. We're always here to help you navigate this world of risk, whether we enter a recession or not, right? And as inflation persists, these prices are going to catch up on your own budget. It's just part of what's going to happen. So please let us know if we can be of help to you. Once again, if you have any questions, 254-282-0495. We would love to answer them. We'll give some more contact information in a moment, but if you have any questions about your portfolio or your plan, just give us a call or a text.
Yeah, send your questions in. We can answer those live on the air, or we'll answer follow-up after the program today. So basically the gist, Jesse, is
our strategy has not changed, right?
No, exactly. July was a good month for everybody, and we'll have to see if that continues. There's still a lot of uncertainty out there when it comes to the economy. The government can mess with things, and we saw that with the downgrading in the U.S. debt rating, that's going to have some volatility with the markets and things. We think that it will all iron itself out over time, but we're going to be closely watching those things. And if you're working with us, you know that we're handling those things for you. If you're not, we'd love to talk to you and encourage you to contact us for a complimentary consultation. We do not charge anything for that. We just want to help you get a good idea on your situation. We'll give you that 50,000-foot view, so that you can see if you're on track. Do you make some adjustments? And if we can help you, we'll certainly talk to you about that. But all consultations are complimentary, and we'd love to visit with you. Once again, you can give us a call or text us at 254-282-0495, or you can call us in the office Monday through Friday at 800-491-4508. And if you just got to talk to me today, you can look at my calendar. I put the link on there. It's calendly.com/Mark Trice. And you can see a time that might be convenient for you to have a phone consultation as well. So thank you, folks, for joining us today. We appreciate your attendance and are thankful that you've taken a few moments just to listen in. For those of us that are our clients, for those of you that are clients, we'll send a copy of this out in our monthly client email on or around August 15th. Have a great day. We'll talk to you next time.